Thank you for looking at this area of our website. If you're looking at this as a result of an email that's been sent to you because you are currently planning an investment with Hurst Financial Consultancy, then please do read this through carefully. And if you have any questions, please engage closely with your advisor, as this is one of the most important aspects of the planning to make sure that the risk of the investment is suitable to your overall approach toward investment risk and matches up with your capacity for investment loss. So if you have any questions related to your investment decisions or the suitability or appropriateness for you of any products described in this document or within any recommendations made to you by any of our advisors, then please contact us immediately. I'm obliged to point out that the value of investments and the income from them may fall or rise, and investors may get back less than they originally invested. So when we're constructing your investment portfolio with you, we all need to consider the risks as well as the potential rewards. This guide helps you understand investment risk and how it can potentially affect your investments. The key areas that the guide is going to look at is understanding investment risk, understanding your risk profile, and we're going to talk about the capacity for loss. We will examine the historical risk-return trade-off and the importance of setting objectives. We'll then tell you, as we move through the report, how investment professionals, like ourselves, seek to manage risk. And then in a broader sense, we'll be looking at general, worldwide and economic risks that can affect investments, and also understanding asset-related risks. There will be a page where you will be able to see our scale of 1 to 10, which has within it risk descriptions, and from that you should be able to choose where you think you sit. After reading the guide, hopefully you'll have a greater understanding of the risks associated with different types of investments. And of course, it's vital that you discuss these with us. So in considering how we get to an understanding of investment risk, all investments carry some risk, but the level of risk varies depending on which investments you choose. In general terms, the higher the risk, the higher the potential return, and the higher the potential loss. You simply cannot build an investment portfolio without considering a number of aspects of investment risk. Generally speaking, you may need to consider accepting more risk if you want to pursue higher returns. If you decide to seek those potentially higher returns, you face the possibility of greater losses, including some, or even in some cases, all of your investment. We have to give consideration to the effect of time on risk, because the longer that you invest, the more time that riskier investments, such as equities, have to recover from any falls. Bear in mind, however, that long-term investing does not guarantee that you will meet your investment objectives. In moving along to the understanding of your risk profile, your personal risk profile shows how ready you are to potentially lose money in return for the prospect of rewards. Your profile depends on your attitude to risk and your reason for investing. It also depends on your financial situation and how long you have to invest for. If you have a high tolerance for investment risk, you'll be more willing to have riskier and more aggressive investments inside your portfolio, such as equities or property, and this is in the hope of making potentially higher investment returns. If you're more cautious, you may want to focus on preserving your original capital as much as possible and prefer more stable, low-risk investments, such as bonds or cash, even though these are likely to offer more moderate investment returns. We need to also think about your risk profile over time. Your risk tolerance will change. At the most basic level, there may be a time to take risks to grow your money, a time to preserve wealth, and a time to live off that wealth. Investors in their 20s may not be too worried about a big drop in markets, reasoning that they have enough time to ride it out and profit in later recovery. Investors in their 50s, on the other hand, may focus more on protecting against the loss of wealth. An important area to consider also is your capacity for loss. This in itself is a relatively new expression that has been brought into use at the behest of the Financial Conduct Authority and is certainly worthy of consideration. We know about the need to create a contingency fund for emergency expenditure, for instance, the equivalent of 6 months' income to be held in cash to cover unforeseen but arguably probable events, for example, a car repair or a boiler breakdown. Capacity for loss extends this thinking and, in essence, is examining how your own personal financial situation would or could be affected by a fall in the value of your investments. It's probably best described by providing a couple of brief examples. Let's look at example number 1 and imagine that the client is a highly paid 40-year-old civil servant with a high, regular level of monthly income and low monthly commitments. And let's imagine that this investor has £50,000 to invest. Although they, like anybody, would never choose to see their investments fall, if the investments fell by, say, 70%, arguably this would have little impact on their ability to function on a month-to-month basis. We could therefore agree with the client in this situation that they had a high capacity for loss. This client can afford to lose money as they have opportunity to recover this situation. Time and earnings capacity is on their side. We'll contrast this with the example on the next page. We can imagine a situation where perhaps a 68-year-old widow with only the basic state pension as her available income, but has £50,000 in savings. If this client was to undertake an investment strategy designed to create additional income, we can see that if there was a similar fall as in the first example of 70% in the investment value, that their savings would be quickly exhausted as a consequence of the fall in the value and obviously the removal of the income from the investment. We could therefore agree that this client has a low capacity for loss, and any investment strategy would need to accommodate this position. In essence, this client cannot afford to lose the money. Remember, it's important to discuss your capacity for loss with your advisor. It can have a significant impact on the type of portfolio recommended. Nobody enjoys seeing their investments fall in value, but it would be a dysfunctional market that only ever went up, and so when making an investment, we need to do so being comfortable that the vagaries of markets does not jeopardize our day-to-day financial well-being, and that markets, and thus our investments, have time to recover where a fall has occurred. So, every investor will have a unique risk profile, and this is why this area needs thoughtful consideration. We can help you determine your risk profile and work with you to develop the plan that is perfectly designed and right for you. I'm going to move on now just to discuss in broad terms some of the expressions that you're likely to hear when your advisor is talking to you about the assets that may be contained within your investment strategy. First of all, you'll hear about equities. These are sometimes called stocks or shares, and they represent ownership in a company. These offer the potential for higher returns, although with higher risk. Your advisor will talk to you about bonds or fixed interest instruments. A bond is a loan made to the bond's issuer. This could be a company, known as a corporate bond, a government, UK government bonds are also known as gilts, or some other institution. Different types of bonds vary greatly in their risk profile, although government bonds are considered one of the least risky investments. You may also hear of the use of property inside a portfolio. This can include, in consideration, the value of your own house, as well as pooled investment funds, which invest in commercial property, often offered by an investment management company. Pooled investment funds are professionally managed investment funds which invest in a range of assets. You'll be familiar with the concept of cash, which is usually held in a bank or a building society account, or pooled funds that invest in short-term cash instruments, such as those issued by the UK government. We need to look at the historical risk-return trade-off. We know that all investments carry some risk, but historically different investments have demonstrated different risk and return characteristics. In general terms, the higher the risk, the higher the potential return, and naturally vice versa. Considering these issues over time, different types of investments, sometimes called asset classes, tend to have different risk-return characteristics. The chart on the next slide shows the historical performance of different investments over 20 years. Each type performs differently each year, and it's very difficult to predict which will perform well at any given time. For example, equities have outperformed other asset classes in most years, but have also produced the largest and most frequent negative annual returns. Based on this historical performance, investment professionals tend to rate the different types of investments according to a risk-return hierarchy, which reflects that if you want greater rewards, you may need to accept greater risk. So the point of this pyramid is just to show you that as you reach the peak of the pyramid, so your risk and your potential reward can increase. Obviously, we have to point out that the diagram is illustrative only and reflects the general way that risk and reward for the different asset classes is viewed. But past performance is not a reliable guide of future returns, and there are varying degrees of risk within each asset class. So here is the chart mentioned in the last slide, and this is looking at the performance of different investments from 1994 to 2014. It's pretty self-explanatory, so you might wish to press pause here just so that you can get a chance to look at the varying returns. We need to consider the importance of setting objectives. Before deciding on which assets to choose, you need to decide why you're investing and how long you have to invest. Balancing the risk you are willing to accept with the investment returns you need in order to meet your investment objectives will help determine which investments to choose. It is possible to invest using these strategies within various tax wrappers, for instance an ISA, a pension, or an investment bond, or collection of unit trusts. As part of your overall plan, the decision to use these various wrappers will sit apart from the investment strategy. It is, of course, entirely possible to take a different strategy with different asset classes. For instance, you may be happy to take a higher risk with a longer-term plan, such as a pension, than you would with an ISA, where you consider the ISA to be perhaps shorter-term money. Different time frames give different approaches. If you're investing for the long term, perhaps for retirement, as alluded to on the previous slide, you might choose to hold some equity-based assets. On the other hand, if you have to pay for a short-term goal, maybe a wedding, you might decide to hold more cash. Deciding on the basic structure of your investment portfolio is called asset allocation. Younger investors, or those with a higher tolerance for risk, might seek a more aggressive investment strategy that holds a higher proportion of equities, since they may deliver greater returns over the longer term, but at a higher level of risk. Older investors, or those with a lower risk tolerance, who are seeking to preserve capital, might want to hold a greater proportion of cash and bonds, which also have the advantage of paying a certain level of underlying income. Let's talk about how we manage investment risk. You can learn a lot of how investments are managed by considering the next 4 areas. These include diversification. It's important not to have all of your eggs in one basket. Diversification simply means spreading your investments across different asset classes and sectors. By not having all of your eggs in one basket and by holding investments that tend not to rise and fall together, you can manage the overall risk of your portfolio. We use pooled investment funds. These are professionally managed investment funds, and they invest in a range of assets, giving you automatic diversification, often achievable through one single investment fund. These funds come in a multiple of types, and they come from many different investment management companies. Part of our role is to help decide which one may be the most appropriate for you. You may hear the expression pound cost averaging. This refers to building up an investment through regular contributions rather than investing one lump sum. So when prices are high, your contributions will buy fewer units or shares, but when the prices are low, it will buy more. And this way, you reduce the risk that you pay too much when the price is unusually high, and benefit from buying more shares when the price is